You've been told that a savings account is the ultimate safety net. And look, for a 3 kilo emergency or a sudden medical bill, it is. Savings accounts are essential for survival, but they were never designed to build wealth. The trap isn't in saving, the trap is in oversaving in cash. While you're watching that balance stay steady in your banking app, you're missing the invisible reality. The purchasing power of that money is melting. Behind the comfort of that digital number is a silent thief called inflation. By keeping your long-term future locked in a vault that pays you pennies, you aren't gaining security, you're losing time. You are trading the compounding power of your 20s and 30s for the illusion of safety. Today, we're going to look at the math the banks won't show you and why treating your savings account like an investment strategy is the fastest way to ensure you stay financially stagnant for the next 30 years. Let's address the elephant in the room. You need a savings account. If your car breaks down tomorrow or your roof starts leaking, that liquid cash is the only thing standing between you and high-interest credit card debt. In financial terms, cash is your oxygen. You need it to breathe. But here is where the safety illusion begins to turn toxic. Most people keep far more than an emergency fund in their standard savings account. They keep their life savings there. They see a growing balance and think they are winning the game of finance. But banks are businesses, not charities. When you deposit your money, the bank doesn't just keep it in a drawer with your name on it. They take your cash and lend it out at 7%, 10%, or even 20% interest to other people. In return, they give you a measly 0.5% or 1% if you're lucky. The bank is literally using your capital to build their wealth while giving you back just enough interest to keep you from closing the account. Now let's look at the math that makes this a losing game. If inflation is running at 3% or 4% and your bank is paying you 1%, you aren't earning money. You are losing 3% of your purchasing power every single year. It's like trying to fill a bucket with water while there's a hole in the bottom. The water level might look the same, but the bucket is getting lighter. In the US and UK, the cost of living, housing, healthcare, education historically outpaces the interest rates offered by traditional high street banks. By over-allocating your wealth into cash, you are choosing a guaranteed loss. You are trading the risk of market volatility for the certainty of depreciation. You think you're being conservative and safe, but in reality, you are making a massive, aggressive bet that the dollar will maintain its value forever. Historically, that is one of the riskiest bets you can make. The illusion of safety is the most expensive psychological trap in the world because it prevents you from ever taking the calculated risks necessary to actually move the needle on your net worth. The psychological cost of this safety-first mindset is even more damaging than the math itself. We call this opportunity cost, and it is the silent killer of the middle class. Imagine two people, Sarah and Mark, both starting with $20,000. Sarah is terrified of the stock market. She remembers the headlines of 2008 and 2020, so she keeps her money in a high-yield savings account. She feels secure every time she logs in. Mark, on the other hand, understands that cash is for emergencies, but assets are for growth. He keeps 6 months of expenses in savings and puts the rest into a diversified portfolio of productive assets, real estate, index funds, or even his own business. 10 years pass. Sarah's balance has technically grown by a few $1,000s in interest. She feels like she's done the responsible thing. But when she goes to buy a house, she realizes that home prices have doubled. The safe money in her bank hasn't kept pace with the real world. She is effectively poorer than the day she started. Mark's portfolio, meanwhile, has been volatile. There were years it was down 10%, but over the decade it compounded. He didn't just preserve his wealth, he multiplied his purchasing power. The gap between Sarah and Mark isn't just a few $1,000s, it's the gap between working until age 65 and having the option to retire at 45. This is the liquidity trap. When you have too much cash, you become liquidity rich but asset poor. You have the ability to buy anything today, but you lose the ability to afford everything tomorrow. In the US and UK markets, we are living through a period where sitting on the sidelines is a strategy with a 100% failure rate for wealth building. If you are holding 6 figures in a basic savings account because you are waiting for the right time to invest, you are essentially paying a massive inactivity tax to the bank. The bank loves your fear. Your fear is their profit margin. Every night you sleep soundly because your cash is safe. The bank is using that same cash to fund the very assets, mortgages, business loans, and corporate expansions that you should be owning yourself. You are providing the fuel for the bank's engine, while your own vehicle is sitting on blocks in the driveway. The most dangerous part of the savings trap is that it feels productive. You see that number grow, and you get a hit of dopamine. But what you aren't seeing is the wealth gap widening between you and the people who understand the difference between saving and investing. In the financial world, there is a concept called the Rule of 72. It's a simple way to see how long it takes for your money to double. If you're getting 10% in a broad market index fund, your money doubles every 7 years. If you're getting 1% in a savings account, it takes 72 years. You are literally trading your entire adult life for a result that someone else achieved before their kids finished primary school. This isn't just about spreadsheets, it's about your freedom of choice. When you oversave in cash, you are pinning your future to a currency that is controlled by central banks and government policy. You are a passenger on a ship you aren't steering. But when you own assets, when you own a piece of the world's most profitable companies or real estate, you are owning the machinery of the economy. These assets have the power to raise their prices to match inflation. Your savings account does not. Think about the average American or average Brit who has worked for 30 years. They did everything right. They saved 10% of their paycheck. They avoided debt, but they kept it all in a safe account. Now, as they approach retirement, they realize that the cost of a comfortable life has moved the goalposts so far back that they can no longer reach them. They were disciplined, but they were disciplined in the wrong direction. The bank sold you a product labeled security, but what they actually delivered was stagnation. They gave you a front row seat to watch everyone else's assets appreciate while yours remained frozen in time. You have to break the psychological addiction to the fixed number. A fixed number in an inflationary world is a shrinking value. True security doesn't come from a pile of paper in a vault. It comes from owning things that provide value to the world. If you want to stop getting poorer every month, you have to stop thinking like a saver and start thinking like an owner. You have to realize that the risk of the market is nothing compared to the guaranteed risk of doing nothing at all. So, what is the exit strategy? How do you stop the bleeding without putting your survival at risk? The first step is a mental shift. You must treat your savings account as an insurance premium, not an investment. You pay for insurance to protect against disaster, but you don't expect the insurance company to make you rich. Your emergency fund, that 3 to 6 months of expenses, is your peace of mind tax. It's okay if that specific pile of cash loses value to inflation, because its job isn't to grow, its job is to keep you from panicking when life gets messy. But everything above that line, that is your active capital. Keeping it in a savings account is like keeping a world-class athlete on the bench for their entire career. It's a waste of talent. To break the cycle, you need to implement a cash overflow system. Once your emergency fund is hit, every extra dollar should be automatically diverted into productive assets. In the US and UK, we have access to some of the most powerful wealth building tools in history. From low-cost S&P 500 index funds to tax-advantaged accounts like the 401k, IRA, or ISA. These aren't just for rich people. They are the only way for the average person to outrun the silent thief of inflation. Look at your bank statement today. Look at the interest you earned last month. Now look at the price of groceries, rent, and fuel compared to last year. If that interest payment can't even buy you a cup of coffee, while the cost of your life has gone up by hundreds of dollars, you have your answer. You don't need a bigger savings account. You need a better strategy. Stop being the bank's cheapest source of funding. Stop letting your hard work be used to build someone else's empire while yours sits in a stagnant pool. Respect the role of cash for emergencies, but respect your future enough to put the rest of your money to work. The goal isn't to have a high balance in a mobile app. The goal is to have a high quality of life 10, 20, and 30 years from now. And that life is built by owning the world, not by lending your money to the people who do. The math doesn't lie and the clock doesn't stop. You've seen the illusion. Now, it's time to move your money into the real world. Start today, because every month you wait, you aren't just staying still, you're falling behind. Your money is losing value while you sleep. Stop the stagnation. Subscribe now to learn how to own the assets that actually build wealth.